put this rally in context because when it started at 15,200, we thought it would be a technical bounce based on short covering. So we've seen that short covering happen in the Indian market once we crossed 17,000 to 17,300. Most of the shorts which we were seeing in the daily participant-wise data that NSE publishes was done. But what did not happen is that the US market has actually been adding shorts on the way up. So we were sort of clear that because of that sentiment, the market is going to extend a little more. Now, the question is, now that we've extended this far, what really happens? And so this is a fight between the fundamental situation in the market and the technical situation. In the fundamental situation, you also have to take into account macros, something that was behind most of the market mayhem last year. Rather than only looking at earnings growth and how the economy is doing, which is where we can sometimes get lost. And so two of the factors that we'll have to continuously watch is one, how is the dollar doing? Because remember that the dollar really broke out of a multi-year trend above 103, 104, and it has really not gone back below that. It's sort of just pulling back and testing that zone. So my sense is that, when you've reached a level like 17,800, what you want to do is step back and think whether the macro scenario has really changed. And if it has not, then I don't want to be in a hurry in going too far out on this market right now, thinking that it's a runaway move and, this is not going to, give us another opportunity to buy, as we call the FOMO effect. And I think that's something to be a little sensitive towards. So after having, chased this rally for, I think, 1,000 to 2,000 points, we've sort of stepped back, reduced our positioning in the market significantly, and are just trying to look at the answer to these 2-3 questions. And so far, none of the answers have changed because the dollar still has strength. It hasn't broken down. US earnings trajectory for the next 2 quarters is still going to be negative because of the tightening which is already in place. We are trying to guess when they will change their stance. But as of now, whatever data is available is still going to point to a weaker US growth environment. And so whether we like it or not, even when at times when India has stood out better, when the world catches a cold, we also end up sneezing. And so that's the kind of situation we are in. It looks like the US is still going to face headwinds in the coming quarters. Unless that changes, the risk is still out there. And so we continue to monitor these factors patiently rather than jump the gun just because it has crossed 17.5 or crossed 17.9, or tomorrow if it becomes 18,000. That won't change my view till either the trajectory of the dollar changes, the trajectory of what we are seeing as a disinflationary trend in commodity prices changes. So you can see oil slowly slipping back, which is now no more on the basis of only what happened in Russia, but actually starting to reflect what the on-ground demand scenario is. I have to really put it in long-term context because we are talking of investors and not just traders, right? Yeah. So when we look at the investment scenario, the best performing sectors of, say, the last decade, which is 2010 to 2020, were essentially the ones that you're talking about, which is the BFSI space, IT services, and a couple of others. And of course, the defensive, which is FMCG. Now, they had really taken a backseat when we got the recovery from 2020. The best performing sectors actually ended up being IT and then metals, companies related to oil like Reliance Industries, which you were talking about. And those are actually lagging behind in this rally. So sort of the theme that drove the last rally is now actually missing in the market. The question is, okay, then should we really change the theme and go back to what we were doing before? And which is where I have doubts because usually if you study the long term, certain sectors and themes work for around 8 to 10 years and then those themes change. So to simply jump back and go back to the themes that we had in the last decade and not look at what was really trying to change and evolve could end up being not the right strategy. So it may work in the short term because right now what is happening is, given the weakness in the macro environment, people are taking a defensive stance. So this stepping back, they're going back to FMCG, okay, and so that's again outperforming. They're going back to BFSI, which is fine. But my only question is, if you've got to get the entire economy moving and you've got to see all sectors behave in a certain way, that is sort of still missing, and that is exactly where my concern comes in from. In the context of oil, I'll tell you all of these news items will be positive, but simply look at it. Oil peaked at around $125 and now is back to $85, $83. Now, when we are looking at that kind of decline, it's already looking at a settled situation as far as oil is concerned. So the question to ask is oil really reflecting the geopolitical risk, or is oil reflecting the demand scenario? Because as much as we like to think that if oil goes down, market should go up, if you take a long enough period of history, you'll find that oil and markets tend to go together. If we just take 2003 to 2008, which was a booming period in India, oil prices also went up, equities also went up. The same can also be said true for 2020 to 2022. By the time market was rising and peaking, oil prices were also rising. So that's never been the issue. The problem is that if oil prices are declining now, not because of geopolitical risk, but because there is sufficient supply, then it's actually reflecting the demand supply scenario. And so if you don't have sufficient demand, and oil prices are declining, then now falling oil prices start reflecting the growth environment. And so if oil prices are slipping, we start looking at that as a disinflationary signal for equity prices to weaken in the coming weeks. So many times you get a bottom also in both oil and markets together because of that scenario, that panic occurs where weakness in growth shows up in oil prices and equities also falling, and then both of them with some lead lag, maybe about a couple of weeks, can bottom out together. So we haven't seen that yet. And I am taking the weakness in oil prices as a signal that equities are overstretching themselves right here. So if they are young, their exposure to the market is still very early stage, which means if you're like 25 or 30, you've just put in your first 1, 2, 3 years of savings and you got another 2 decades to go. Then in terms of your long-term wealth, it's a small proportion. And therefore the hit they're taking is actually very minuscule compared to what they will end up in the long term. So I wouldn't tell those people to really run from the markets if they're doing an SIP kind of investment. And if I say, okay, markets may be going through a tough stage, they could be bearish for 6 months, and an SIP investor wants to still keep nibbling into the next 6 months. If he's young, it might not hurt. But if your corpus is already sizable and you see a 20-30% drop in the market, it definitely starts hurting. And for those investors, I think the strategy, at least what we are adopting in that sense, where, if I have a larger pool of capital, I am creating significant amount of cash at these levels so that as and when opportunity, presents itself, we can redeploy that money. And also we continue to monitor the macro environment, because I'm not saying 100% we can ever be right, but if the macro environment changes, which like I'm saying it still hasn't, then we can always re-enter. There's no harm in entering the market a few percentage points higher and being clearer about what is going on. But right now we don't have that clarity, and which is why creating some cash is a good strategy for people who have a larger pool. But for investors who are doing an SIP or an early stage in their investment cycle, I don't think they can get too worried.